What's up, guys? Just wanted to kind of go over, I guess, more of like an overview of liquidity concepts, and really sort of understand how things form in the market, how liquidity is essentially created, how you can benefit from waiting and sitting on the sidelines while liquidity sort of builds for moves, and ultimately how it will affect how you get involved with the market. So there's a few examples that I can kind of look at that I can see just plain as day. The first of many, it would be something along the lines of this piece of price action. Okay, let me just zoom in, and again, like hindsight is 2020, but you can go back and look at how all these things form. Previously, and what it takes to actually be able to move the market. So let's actually start up here. So you'll notice, and again, this might be very, very basic to some, but it's a good reminder, it's a good refresher, and obviously this is just on a 4-hour time frame, but if you go across any time frame, this is exactly what we're essentially looking for to be able to, facilitate the move that we're anticipating in the market. So if you look, something like this, right? And we have ultimately tons of built up mitigations, tighter mitigations. We're pushing through, we've liquidated, and we've come down, right? Then we've mitigated some form of demand, we've failed to take it out, and then we create liquidity right here, right? So it's always this back and forth between liquidity to take, liquidity to target. Yoda. Sorry guys, my dog's just drinking like a fucking mule right now. But it's always this banter back and forth between liquidity to take from the market, liquidity to then target in the market to be able to push the market in this trending direction. So when you look at how these things build, right, and you see these relatively equal lows sort of building in here, we see something along the lines of this where we break up and basically break through a supply zone in this case. A lot of people want to trade these levels in here as demand, and you know what the problem is that a lot of times you're going to get a strong reaction to these levels, and the reason why they do that is because smart money, true smart money, knows that this is just a distribution schematic, right? We're literally pushing the market back and forth within a range to collect more orders to be able to push price in the overall intended direction, right? So when you think about liquidity concepts, what I want you guys to be thinking about is the number of times we revisit a zone, especially a demand zone, in the premium of a previous leg, okay? If our downtrend is sitting like this is all sitting here to generate more and more and more liquidity, right? And the market will only be able to move in this direction when all liquidity is facilitated and filled on the opposing side. And what I mean by that is that if you look right here, there was no way for anything to happen from this point. And the reason why, Yoda, this dog fucking drinks like a fucking horse. There is no way for price to come down into here and break through this low. And the reason for this, and again, hindsight is 2020, but go back and look. Okay, I need you guys to go back and look. It's not about just trusting me. It's about understanding that these things happen every single time. And it's a big part of the reason why our trade plan is formulated the way that it is. So when you look at this and you say, okay, we've come up, we've essentially mitigated this piece of supply up here, we've pushed down, you can see that above these equal highs, right, as it sort of prints. Now you're going to get involved here, right? You're going to get involved here, but you're going to know that there's unmitigated demand that technically comes from a sweep, right? So what is that going to do? Well, we need to entice buyers, right? We need to entice buyers into the market. Why do we need to do that? Well, from a institutional or a hedge fund sort of perspective, knowing full well that in order for price to want to come after here, right, we first need to satisfy everything that's up here, right? Because if we want to be able to go only in this direction, all orders need to be accounted for up here. So it's kind of like this weird math equation where it's yin and yang almost. Like ultimately, as we push down like this, okay, we know that this high should technically be protected. Why do we know it's protected? Well, we've had 2, 3, one, two, three failed demand levels. We've created liquidity to grab from the market, and then we've created liquidity across the highs to be able to come up, sweep, take, and ultimately what ends up happening here is that once all of these orders that are resting above these highs or in the absolute most premium areas of the original order flow realignment, once those are facilitated and there's no more orders resting here, I always think about liquidity as, okay, if there's no more orders in the market, nothing, everything has been taken from the market, and we could see that by this wick right here and then this candle right here. Where are orders resting? And that's the bottom line. Where are they resting? They're resting below the lows, right? Why are they resting below the lows? Well, it's very simple. We've liquidated all of the positions that are sitting above here. We've already seen the order flow realignment. We've basically got the initial tap and then the sweep. You'll notice in our trade plan that we always look for that liquidation of the first mitigation. And this is a prime example. This is a huge, huge factor when considering getting into these positions and being more selective about what areas to essentially trade from. So same thing happens as we move down to the right-hand side, right? So if you look at this, 90% of smart money traders see this as that stupid fucking word, a chalk, a change of character, whatever. This is an order flow shift. Everybody assumes a chalk is just a reversal. And to a certain degree, an order flow shift is the same thing. But when you just think about the nature of the word, order flow shift, it's just shifting temporarily. We are not expecting price to come back up and take 2017 highs out. Like, that's not what we're looking at. What we're looking at is the same thing we just looked at here. So if you imagine this point right here as this point right here, what do we need to do? Well, it's very simple. We need to come back down and revisit it. And what do we need to do? We need to create liquidity. We need to manufacture liquidity, because the only way that the market can't just move here, because there's going to be orders now sitting above here. People want to trade from here. People want to trade from here, here, all over the place, right? So there's liquidity available for the market to seek out in the form of orders. So as these things progress, don't FOMO into and again, 1 minute, 5 second, 15, 13 minute, whatever the fuck time frame you want to go on, it's all the same. There's nothing different about time frame to time frame. It represents the same idea. It's when you piece these things together that you can formulate these huge RR trades, and there's no secret sauce. Look for the same thing on every fucking time frame. Okay? It needs to happen on the 4 hour to happen on the 15. It needs to happen on the 15 to see it on the 1 on the 5 second, yada, 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 and so forth. We get the initial tap. Okay? Tons of people selling right here. They see the liquidation. They want to bring this down. Well, there's demand here, right? There's demand for higher prices. So what do we need to see? We need to see orders and people essentially trading from these zones. We don't want to trade counter trend. Why not? Because when you trade counter trend, you lose sight of everything. You see equal highs up here. You see you want to hit that home run trade, but you're forgetting what side of the market to be on in the first place. So anyways, tying this all back to sort of like liquidity concepts and just understanding. Liquidity is one of these things where it's either it's too heavily weighed or it's not weighted enough. And I think the sweet spot is just understanding that liquidity is fabricated over time. Orders get placed in the form of stop losses, in the form of breakout traders with sell stops. They get formed over time based off of development in price. And the only way that we can seek out this liquidity is when there's nothing left across the highs. And when you see these sweeps, this is the big part of the reason why we utilize the strategy the way we do. Look at this. I can't make this stuff up. Every time we hit a POI, okay, let's just go like this. Okay, we've got this POI. Oops, something like that. I would call this a tap, okay? Like, I know it's not quite mitigating, but you get the idea. We get the tap, this doesn't break down, boom, this breaks down, comes back up, mitigates the flip zone in here, and then away we go. So you have to understand that liquidity to target is nothing without a take on liquidity. So understanding that we essentially need to clear out every order that rests above highs to be able to go after these lows. Because if there's orders resting here, we're going to move like this, and then we're going to move like this. We're going to move like this, we're going to move like this. And that's what we know as consolidation, right? Or this more choppy, tightly mitigated sort of PA. So this is all liquidity, yes, but it means nothing until we sweep and then break down, right? So I know this is kind of just a ramble, and maybe this isn't the greatest lesson, but I want people to start thinking about liquidity as what it is at the root of it, and not just equal highs and equal lows. It's the form. Liquidity is just a funny word for the amount of orders that are resting at specific levels represented by candles. So if we were to cut price off right here, right? Yes, we have liquidity, but we also have liquidity above the high. Why do we have liquidity above the high? Well, because we couldn't break the low, right? So there's incentive for price to continue moving this general direction until there are more orders here than there are here. If there are more orders here, so you have to think about this in real time, how this works, right? If the market moves down into this level, okay, and we create liquidity now, and now we have these equal highs, relatively equal highs resting above here, where do you think the market wants to go? This is all going to get ran, but wouldn't it make a lot more sense, and wouldn't it be a lot easier for the market to start moving in this overall direction once we take out the equal highs, right? We don't have to worry about these. These are already protected, right? This has already done its cycle. Now we're coming back up to mitigate the last of the orders, and as long as there's liquidity above the highs, we will never be able to go after the lows. Keep things simple. Understand that liquidity, if there's one concept that I can really drive home out of everything I just said over the course of the last X amount of minutes, liquidity takes time to build. Liquidity is something that happens over time. We can't just say that there's liquidity. We can't just assume, yes, there's liquidity. There's been liquidity underneath these lows the whole time. Is there more liquidity here than there is here? Is the question that needs to be asked. Where are orders stacking? Which level needs to break first to be able to go after our intended direction?